Good day, traders, and thanks for the gathering. And it's been a great privilege to see many of you are synergizing with one another and supporting one another to get the right answer. And as of today, we are one of the biggest team. And give yourselves a good applaud. Congratulations to the team, and hope to see a continuous growth all the way to the future. And just now during the gathering, many of you have posted some questions on the short selling. And many of us who started a trade in our trading journey, we have started our trading journey going long. That means we are very used to buy or placing buy orders. So it's like we are always using our right hand all the time to write, and now we are using our left hand to write. So it may be a bit uncomfortable in the beginning. Now, as you practice more, that you start to get a bit more comfortable uh, in the end. So now, let's say, for example, in this video, what we would like to talk about is placing orders on a short selling example. So let's say this one of this stock, Harris, HRS, has been making a huge gain, about 400% gain in about 5 years. So now this year, this index is getting very volatile, and investors are getting pretty nervous, and it's almost time for them to cash out. So let's say now we zoom in a little bit, and we can see that the price reaches to a level around 170. It faces a strong rejection there, and these investors are probably cashing out at the level 170, and it forms a huge red bearish candle, where we call this a bearish engulfing candle. And to many traders, this is a very bearish signal, and this is where they can draw a line, a key resistance line on top of this candle in the wick at the wick of this candle. And as a price goes down to a certain level to around 145, and it converges with the moving average, the long-term moving average, some investors in the market might still see might still believe that this stock still have potential to go up, and it sends the price as they buy, then it sends the price further up. But when as it reaches closer, revisiting the levels of 170, it slows down, and it loses some energy there. And as it is decelerating to the price level of 170, it faces again a very strong rejection at these 170 levels. So now, possibly it's a very probable when a price gets rejected in this level very strongly, that if price starts to revisit or tries to break those levels, then the price will start to get rejected above those levels and starts to close down. Now, let's say, for example, in this case, that the price starts to tries to go up to 170 above 770 level, and it gets rejected very quickly. So now there's a very bearish sign when price gets rejected very quickly, and it goes below the previous key resistance level. Then a lot of traders will see this as a short selling opportunity. So this is where a lot of traders also calls this a failed breakout, or calls this pattern alone double top pattern. So now there are two types of sell orders we can use at this point. So first is sell limit bracket orders. Second is sell stop limit bracket orders. So now what we care to focus right here is to focus on sell limit bracket orders, where also before we even want to sell a stock, we want to see what is the next tree we need to chop through, or if there's any major support that is blocking the way as you want to short sell the stock. So first, you want to see which entry level is the most optimum level that we want to sell this stock. So let's say you want to place this sell limit order around 170 level. Then you have to look for some buffer and place the stop loss above the key reversal candle wick. And also with that, you get your target price. So let's put some risk reward ratio. So the projected risk reward ratio is around 1 to 2 in this case. Some can come into 1 to 3, the ratio. So now upon sizing that with your position management tool, you can get some numbers right here. So you have a sell limit about 170, stop loss 177, target limit around 156. So with this bracket order, what you can do is that you can go to the platform, Thinkorswim, right? So let's say, for instance, in Thinkorswim, I've actually drawn some of these lines, and also I've projected the sell order and the stop loss and the target profit right here. So click anywhere on the screen, right click, and then go to sell custom with OCO bracket. Then in OCO bracket, you can actually look at the number of shares that you want to sell. So you have to use your position management tool with the price projected here, then factor with that. Then you can always choose the number of shares to sell right here. So now in this boxes here, you can see that whenever I press the number of shares to sell, the target limit, the target profit, and the stop loss number of shares to buy, it follows in parallel whenever I click this button to increase and decrease the number of shares that I want to sell. So this is because I've set the link order or link quantity of shares that I want to sell or buy. So when I click this link right here, you can see that it goes in parallel whenever I increase or decrease the number of shares that I want to sell or buy. So if I unlink this, click this button to unlink, so I would have to press the number of shares manually for each of these column right here. All right. So if I link it back, it follows the number of shares that I want to sell. So now after that, you might want to see the price that you have. You might want to set the price you have projected here by just clicking here. Then the price that we want to sell is around 170 entry, the sell limit order. Then the target price is around 156 in this case. Then the stop order is around 177. Always set the stop order to mark, because a mark represents a very hard stop when the price reaches to 177 level. When price reaches at 177, it actually closes out the order directly, closes the trade directly with no hesitant. Okay, now all these trades are actually to be set as you're waiting for the price to go. Once after the rejection, you want to wait for the price to go back up to around 170 to close to actually get into the trade. So it means there's a lot of waiting. You might not want to set it today, because if you set it today with this order and you send the order ticket, it's only active for 1 day. So the next day you have to set this order again. So now to set this order until it is triggered, then we set a good till cancel order, which in short we call it a GTC order. So only when the price reaches to a certain to 170, then it triggers. It gets both the buy order 156 at the level of 156 target profit, and also 177 stop order to be active. All right. So once all these numbers are set, then you can click confirm and send. It pops up order ticket that you can see the cost of commission for going into the trade and getting out of the trade. So in this case, it costs you around 20 US dollar total. All right, if you're selling amount of 40 shares before you click the final send button. So let's go back to our slides and conclude this. All right, so I've also stated the steps right here where you can click one by one. I'll send you the slides later. Step by step that we indicate right here, where you should click in sequence to get your orders right. Okay. So, okay, what are the pros and cons when you do a sell limit order? So now the pros is that you can always sell your shares at an expected entry price or better. So if you have a sell limit order, then your sell limit is very close to your stop loss. So you have a very tight stop loss, which also translate into a very close profit target. So you get to get out of the trade as early as possible in your sell limit order. Then the cons is that if the price is too strong, then you get to miss out of the trade sometimes. Okay, there are stocks that we don't short sell. So these are the main ones, the main criteria, or that we don't actually sell biotechnology, pharmaceutical stocks because they are subjected to FDA approvals. So once a stock is a company is announced it has acquired FDA approval, then the stock might jump around like let's say for instance about 20% or more. Some even jump up to 100% gain. So if you short sell those stocks, you might lose more than expected. So some even can blow your account once it jumps out hundreds of percent. And technology stocks are actually very subjected to patent approvals, and also price has a huge gap once it announces its patent approvals. So you might also lose more than you expect or intended. Then small cap stocks also we avoid. It's below 2 billion market cap, and very low liquid stocks, low volume stocks, less than 200K daily average volume. So and we don't short Tesla also as well because recently, the last 2 months, we've seen Elon Musk has been tweeting, and so it's not too healthy, for us to short a stock when the CEO tweets. So it gyrates the stock and send it, up and down the huge swings. All right. So, all right. I hope you get the idea of short selling, and I hope you enjoy this session. And happy and trading and investing. See you all again.